Hi, good day all. Welcome to Chapter 6 of our Practical Finance course. This time we're going to cover the part number 4 of our business case model. We're going to make the financial worksheet model. So please stay tuned, you're going to love it. Okay, so today we're going to make our finance worksheet. This finance worksheet needs some inputs from the other worksheets I made, and also we need to build some sort of a cost of sales worksheet. Of course, we're going to do it on the same finance worksheet, but it's strongly needed because our company is selling bottled water that needs water, of course. We will use it normal tap waters at the regular price, and because we could do it from a water stream, but that needs some sort of other investments involved in obtaining that water from the stream. So to keep it simple, let's make it a regular tap water. Also, we need the bottles that we need to purchase from the bottle vendor, the taps, the labels, and the other expenses like marketing expenses, sales expenses, taxes, and maintenance, and everything else is going to be in the expense section of our income statement. So please join me at Excel. We're going to have a great time. Okay, here is some work ahead I made. The cost of sales, which I talked about in the introduction, that consists, of course, of the water, the bottle, and the sales commission. That's mainly the cost of sales of the bottle. The water itself, it's depending on the tap water price of the city where you are. So I took an average of around 30 cities of the United States, and the price per gallon is around $0.025 per gallon. That translated into liters, and I saw a mistake. I had a typo in all the liter words that I use in the market, so I fixed them already. So right here you will have only the word liter correctly spelled. Sorry about that. Okay, so the water price, which I'm going to need because I'm going to work all my business case in liters, is going to be the dollars per liter. This is the price, just the division of this by the amount of liters that there is in a gallon. Okay, so I use a price increase per year. I heard a blog about a water expert. He was telling that a 3% increase per year is mainly what they are seeing in the past few years. And the bottle price is divided in the bottle itself, the tap price, and the label price. I made all this up, really. I don't know what the prices are, but I think it should be around, I don't know, perhaps 25% of the price of the bottle. So I began with 25 cents. The cap, I think it's called the cap, not the tap. Oh, I'm sorry, I meant cap. The cap price and the label itself. The cap price I set it at 1 cent, and the label in perhaps 10 cents. So if we add all this up, we obtain the price of the bottle at 36 cents. The first year is going to increase. This is like the inflation rate, but it's separated, so maybe marketing prices grow less than the bottle itself or the cap itself. So mainly these are the ingredients for the bottle price. Also the sales commission, I made it up too. I don't know, I think perhaps 10 cents per bottle could be a good commission for the salespeople. So this is of course all adjustable. Let me put this in green, as all these must be input by the user. The other years are just growth, depending on the growth of the price or the commission in this case. So I add up all the commissions. So I add up all the costs. So this is the 37 cents of the bottle plus the 47 cents, and of course plus the water price. I'm sorry, the water price needs to be somewhere. Let me insert here, because it will depend on the size of the bottle we're using, right? So if we have I had it in the market, the liters per bottle, this one, okay, which I'm going to take it from the market. So this is all input from a formula of the market, which is right here. Okay, so I will copy that up to the 60 right there. So depending on that, we will have one more row. And now, if this is the price of a liter, right? So the amount of liters that are in a bottle is half of it, right? So we need to multiply that by the liters per bottle. Right. So this, as I get more decimals, okay, and I'm gonna copy all that to here. Okay. Of course, these two columns, let me erase this. Okay, so I have here the cost of water. Per bottle. And this cost of sales will be per bottle too. Let me use this wording. One last thing, I would like to have this in under the water section, so please let me insert this here and put all this right here. Right here. Take this away. Okay, so I have the water, I have the bottle, and I have the commission. All this need to add up to here, so I'm missing the last part, which is the water price. And let me copy that to the end. As you see, the water price doesn't affect very much the price of each bottle, because the water is almost free. So it's the other processes that increase the prices. We can also make some sort of a graph stating how much percentage of, so like this, for example, cost of bottle is, as you know, this, and which depends on the water, the bottle itself. We could put the cap, the label, and sales commission, something like that. Okay, and this we just look it up here, the water. I can do the graph like this, and let's see what they recommend. Could be cool. Okay, so we will have something like this. Wait, let me get this out of the way. It's down here. Could be good. Okay, and the water itself, the water price. Wait, what is this? Oh, I'm sorry. There you go. I think I should have to change it here. Cost of bottled water. Yes, it's automatically changed. So you will see that the biggest part of the cost of the bottle is the bottle itself, the plastic bottle. Also, then the sales commission is pretty good, pretty high, as well as the label. But both the cap and the water itself represent almost nothing in the cost. And all of these, only one line is part of my financial, which is this one over here. So what I'm going to do is that I'm going to insert a lot of lines right now so that these goes buried in the bottom. Insert. All right. Whoops. Okay, let's take this out. Okay, I think more lines are needed. So let's begin with my financials. I always like to begin with the income statement. So right now, let me fill out the lines I'm going to be using in the income statement, and I'll be back in a minute.
Okay, so I have here all the accounts that are usually in the income statement. But first I wanted to add a couple of lines that I might need for future formulas. And those are related with the growth of my company. First of all, the number of bottles sold per period and the average of bottles per minute, which determines the size of the company. Okay, so revenues are of course taken from the market worksheet, so it's pointing at this first month of the revenues. The cost of sales is the account I just made down here. Remember the cost of sales, but of course you need to multiply it by each bottle. I did some modification to the graph because I added the government tax. Okay, depending on the state and depending on the city, you might have a tax to the revenues of your company, and so I added this tax over here, which is mainly the amount of revenues calculated up there times the 5% divided by the number of bottles, so as to obtain the cost per bottle. And so it's another extra line for the cost, which, as you see it in the graph, is the green slice. Okay, so this cost of sales per bottle, you multiply it by bottle. Here, you multiply that by the number of bottles, and you have the cost of sales. Okay, then the expenses. Personnel is taken directly from the Human Resources worksheet. The maintenance is always done as a percentage of the investments that you have installed so far, divided by 12. I mean, it's 25% of the investment divided by 12 is the normal equation I used to employ in my business cases. So you just have that formula throughout all the months. And rentals. Okay, rentals and utilities, I did a different trick. I had this fixed and variable that we need to use in the formula, and it's as simple as take the fixed value and then add whatever the variable factor times the growing thing. And this time I used the average bottles per minute being produced. So if I have a small factory, it will be my $5,000 times $250 per each of the average bottles produced. So it's a $10,000 rental, which seems fair, and it starts to grow per month because the factory is being resized and getting bigger and bigger. So at the end of the first year, I will be paying then $72,000 of rental, and that grows, of course, every year. So these are the yearly rentals of your factory, and of course it's just a guess. If you could pay her $100, I have no idea how much it could be, but utilities the same. We have a fixed value. Say utilities cover electricity, water, garbage disposal, security, which of course have to do also with the size of your factory. So the same thing that up here, I begin with a 500 fixed cost plus 100 times whatever the average bottles is. So paying $2,700 per month at the beginning sounds reasonable, so I use these two figures. Use a lower one if you want. Administrative is just a percentage of my revenues. This should cover other things, you know, papers, legal expenses, etc. So that should be covered by this 5% of the revenues. Sometimes it's higher. Well, no, you could use 10% if you want. Bad debt is also a percentage of the revenues. It's some figure between 1 to maybe sometimes 3% if you have bad customers. So I could use 1% for this purpose. And other is anything we come up with in the future. It's right now I had a 2 just to test if the formula was right, but we could put it 0. So you have then the EBITDA. These are the earnings before interest, taxes, depreciation, and amortization, which is a known line in the income statement. And is of course just the formula of the revenues minus the cost of sales minus the expenses. And we produce also the percentage of that because it's a figure that could represent somehow the profitability of your company. Okay, then depreciation. This is taken directly from my worksheet of investments. Right here we have the depreciation per month. So I just take it here and add them up per year. Financial expenses is something that we must work on right in the future because it has to do with the loans that my company will require to have cash flow and overcome payments and all stuff. Okay, then that takes me to the EBT, which is earning before taxes, and here comes the income tax. The income tax is calculated in a yearly basis, so it's calculated right here, and then what I do here is I divide it by 12 because we do some sort of accounting accrual per month. So this is the yearly calculation. I use the max formula, which of course if it is a negative value here, you shouldn't have a negative income tax. So what you do is that whatever the maximum number between 0 and what you get by multiplying the EBT times the 34%, you put it here. If it's a negative value, it will show up as 0. Okay, so 34% is the figure. It would depend in each individual state where the company is made, right? So I think 34% is a good figure. Then we have the net income, which is just the EBITDA minus the depreciation, the financial expenses, the income tax. Okay, so and then we do that as a percentage of the revenue also, and we then are ready at least with the income statement. Okay, now we have to work out the balance sheet and the cash flow. First, I'm going to begin with the cash flow, so stay tuned. Okay, so I did some work ahead, and first of all I wanted to start with the detail of the investments. I know we already have it here, but I wanted to classify the investments
into pipes, equipments, and filters. Why is that? Because probably there are different vendors, so we could negotiate different payment terms with each one. You will see why in a minute. So to begin the cash flow, as you see here, we have an initial cash flow. It's like a bank account, okay? So you put here the beginning balance and here the ending balance. And what are the things that fill up the cash flow? Of course, the revenues that we collect, any new cash that I get from the banks, from loans, and the rest are mainly payments, the expenses that we pay, and you will see in a minute why it's not the same as expense, because these are payments, which is different from expenses. I'll explain in a minute. The investments that we pay, the principal payments for the loan that I got, and if I pay any dividends to my stockholders. Okay, so of course the ending balance is just the adding of the positive ones and subtracting the negative ones, and that's mainly the cash flow. From this cash flow, what I really need is actually this, what is inside. I'm not looking for the balance to study the profitability of my project. I just need to understand what happens with all my cash flows. I mean, what we call the operating cash flow. And from here, I could calculate too the interest revenue. Why? The ending cash flows is my actual balance of the bank. So I could say that perhaps 80% of that balance at the end of the month, it's like another investment that I can make with the bank at a certain interest rate. For example, let's say 4% that I could earn with 80% of that total balance each month. This of course is nothing, but here it's interesting when the company is growing. See, you have $4.8 million that you shouldn't have it in a checking account. I mean, you could put that on a CD and earn 4% a year. Remember the formula to obtain the monthly interest? Okay, this is the year interest and this is the monthly interest. Here's the formula. Okay, so this is just a multiplication of the available balance that we have, the ending balance of the previous month, which is the same as this one, but I was having trouble with circular references, so I decided to point it here. Well, one last thing before we proceed. Remember that I told you I was going to explain to you how why was the difference between the payment and expense, as well as collections and revenues. Well, as you see, these complicated formulas that I'm using has to do with a small table that I placed right here at the bottom. Okay, here it is. That is helping me to understand how do I collect my revenues. In less than 30 days, 60%. From 30 to 60 days, I collect 30%, 9% below 90 days. So I mean 99% of my revenues are already collected in 3 months. So nothing else after that. So it remains 1% that I'm not collecting it at all. Is what I call bad debt, or the debt that you have to write off from the balance. So this has to do with the revenues. Okay, if we had different revenues, we could have several lines for this. I mean, revenues, if we have different lines of business or whatever. And in terms of expenses and investments, as you see, I divided the investment in 3. Remember up here that I divided the investment in 3 here, right? Where in equipments is the sum of 3 of the equipments, pipes are just pipes, and filters are the sum of the 3 filters that I have in investments. So right here, as I told you, it could be from different vendors. So it is possible that we have different terms of payments. Perhaps the filter guy is the more aggressive of the three, and I must pay them just before a month 66% of the debt and 34% over the next month. The equipment, it is giving me at least more than a month to pay the whole debt of the equipment. And the guy from the pipes is the best vendor of all, and is letting me pay after 2 months the pipes that I buy in a particular month. The rest is the bottle. All the cost of the bottle is right here. I was able to negotiate with the guys of the labels, the caps, the plastic bottles, and the water itself. Well, perhaps you cannot negotiate the water. So let me put, I don't know, maybe 25% here, 75% here. And all the other expenses are right down here. This is personnel, maintenance, everything which is in the income statement is right here. So one last thing. Okay, after the cash flow, then I have the debt that I need to pay, or the loan of the bank. It's just a simple section of my financial sheet that will help me calculate when I pay the debt. Let's put an example. We ask for $100,000. Here's the debt that I pay. Here's the initial debt, of course, begins with 0. The new debt then with the calculation of the payment. Let me explain briefly what is this formula about and why it's so complicated. Of course, this is 136, because I have 36 of the new debt plus the initial debt that I have. I must pay in the month, right? So the only thing, this nested ifs that you are seeing here, is because if you already have paid the debt, it shouldn't reflect the same amount of payment that of the previous month. So if you see here is the previous month payment plus whatever new debt is coming in. And also, if there is no more debt, it should just place a 0. And also, this 0.01 is because sometimes when you divide by a number, it's not giving you exactly 0. So I must ask for something a bit greater than 0, so to be sure that the debt was actually paid. So that's mainly the formula of the amount of payment. It's just the debt that I have, which is the initial debt plus whatever I paid, divided by 36. Okay, and here this is only the debt, and here I calculate the interest expense that I'm using in the income statement. So you have here just whatever the debt or new debt you have, multiplied by the monthly interest, which is the same formula that I use up here. And this interest is, of course, just the monthly interest of whatever the bank is charging me as the annual interest. This is the interest expense that has to go to up here to the income statement. I don't know if I told you, I split it up due to this circular reference thing. I had to split out the financial expense and the financial revenue. So it's see, these two are 0 because I'm paying 3 years in 36 months. That's why I have no more expenses here. Okay, so my cash flow is ready. Some part of the short-term debt is also ready. What I need to do now is accounts payables and accounts receivables and the inventory, just to fill out the balance sheet, which I hope it balances. Stay tuned.
Okay, so here they are, the accounts payables. First, it's a pretty easy section before doing the balance sheet. And as you see, is pretty much as the cash flow in the expense side. You have an initial accounts payable, which is 0, then the prior month ending accounts payable. The generated part is all the expenses and investments, everything that you pay or should pay in a particular month. So here is the sum of all the expenses and capex and costs except the bad debt. Why? Because the bad debt, this one over here, is something that you accumulate in the balance sheet and then you write off at the end of a year. So it's something that is not actually paid. Okay, so that's why it's out of the generated accounts payable. Okay, so the paid section, which is the things that you're actually paid in the month. Let me remind you the small matrix that we did, which states that all our expenses are paid in this way, depending on the type of expense or investment. So the same formulas that I did in the cash flows are here in the payables. So the same thing for the equipment, the same thing for the filters, and then the cost of sales is the same thing. It has to do with only the cost of sale line, J13, which is this one over here. Okay, and once we get all of the expenses or the paid expenses, we then calculate the ending accounts payable, which is just the initial plus the generated minus whatever we paid. Okay, and that is the beginning balance of the accounts payables for the next month, and so on. Last but not least, we calculate the accounts payable days, which is an important figure in finance, and it's mainly 30 times whatever the ending accounts payable is divided by the everything that is generated. And in the yearly section, we just take an average of the individual months. Okay, accounts receivables. Accounts receivable is simpler because it's just one line of collections, which is the revenues that are generated. This is just the revenues. Of course, I added the financials revenues, okay? Because it's negative, that's why I put it in a minus sign, but you could add it from the cash flow that I think it's here. Here, the interest revenue. You could add it from here. But I took it from the income statement. Collections. Okay, collection, I have to add that formula 2 to the collected revenues. Remember the J29, I mean the interest revenues? I have to add it here because we're collecting every interest that we get from the bank. So they are collected revenues too. Okay, so this is just the collected revenues that I already have in my cash flow. Okay, write-off, it will be 0 except the month 12. In the month 12, we will get the whole bad debt of the first year, then 0, 0, 0, 0, and by month 24, the whole bad debt of the second year, 0, 0, 0, 0, the whole bad debt of the third year, and so on. Okay, so now the balance sheet is then, I have here the format, of course pretty simple, not very detailed. The assets, which are subdivided into current assets and net fixed assets. The current assets are just the cash, the receivables, and in the inventory that I have it in 0 because of course now the inventory that I have here has to do with the bottles that I am using for selling my water. So it's like it's part of the cost of sales. So this inventory is not part of my project. So it's always zero. Okay. And the cash is, of course, the cash that I have upstairs in my ending cash flow. The receivables is the one I just constructed down here, the account in receivables. The allowance for doubtful accounts, this is important because it's just the bad debt that I will accumulate. I mean, it's the previous month bad debt plus the new bad debt. Of course, this one is zero, but in the future months, it will be the previous month plus my new bad debt. So this thing is being accumulated, and by the end of the year is when I do the write-off. So you see that it's up to the 12th month, and then it boom returns to zero because of the write-off, which is down. I will show it in a minute. See, this plus J111 is something that we have constructed in the receivables. Right here it is. Okay, so this is mainly what the assets, the current assets are. The net fixed assets is just the accumulation of investments I've already made. It's called property, plant, and equipment for short. And it's just the accumulation of these investments. So what I do is that I do a sum with the J37 in absolute and the other thing relative. So I could copy then the formula to every month like that. And the cumulative depreciation is the same thing, but with the depreciation, the sum from the first month to the whatever month I'm in. Okay, so that we subtract each one of them, and we have the net fixed assets here. So the total assets is the sum of the two, and up to the liabilities we have the payables and the debt. Of course, payables I already have it, is the account payables, ending account payables. The debt, of course, I already have it because I already constructed. It's right here. It's my short-term debt. Then the total liabilities is the sum of the two. Okay, the equity has a bit of a trick. Here, the share capital. This is going to be the initial investment of our stockholders. So it's coming from this cash flow. This one is an input from the user because it's the amount of money that the stockholder invests in the company. Okay, so that $60,000 I put it as an example, but of course to obtain the positive cash flow, I think you remember that, is this one over here. And that is pretty constant. As you see, all the other 60 months is the same. Okay, so it's like the initial investment of our stockholders right here, and remains the same throughout the 5 years of our project. Okay, retained earnings. Retained earnings, as this is the first year, we don't have any retained earnings. So it's a zero the first 12 months. The month 13 is when we start to have the retained earnings. Then what do we do here? Then we sum all this net income. You know, it begins negative, but you start to sum everything up to here, and then you obtain the first year net income, which is this $869,000, but of course you don't take it from here, you take it from here. So this retainers should be this one, and then you in the next year then you would take both of these years, and in the month 36 you take the 3 years, and so on. Okay, but you need to subtract from here
whatever the dividends that you have paid. And that's another calculation that I must show you in a minute. So let's get back to the formula of my 13 month. So you have that cumulative net income here, and then the subtraction of whatever you have paid in dividends as a sum also. Okay, so how do you calculate the dividends that you pay? Well, right here, here's the formula I used. What I ask for is if this sum, whatever the retained earnings plus the cumulative of the net income is, if it is positive, then it means that you didn't have any loss on previous year and you start to getting net income, and that you should somehow distribute that to the stockholders. So what you do is that you ask if this sum is positive, then you take whatever the minimum value is between that sum, I mean the retained earnings plus the net income, the cumulative net income, or the net income itself times a certain percentage, which has to do with the legislation where the company is, because there are countries where you are not allowed to distribute the whole net income, and then there are countries that they allow you to do so. So this percentage that I place here is exactly that. I mean, how much is allowed to distribute as a dividend from the net income. Okay, so what the formula does is it asks if there is enough retained earnings, and then it distributes whatever it's lower, the percentage of the net income of that current year or whatever you have accumulated. Okay, so let's go back to my equity. Okay, so that is my retained earnings formula. The cumulative net income occurs the same thing. I mean, this is always the net income plus whatever the net income of the previous month is. So you start to accumulate the net income here up to the month 12. Then, and the next month, you begin with a new net income of my month 13, and so on. That's the cumulative net income of each period. Okay, so this is mainly the net income up here, right? And the yearly value is just all the net incomes. Okay, paid in dividends. So the thing I just told you, the way to calculate it, I already explained, and so here is actually whatever is paid to it's just the line of the cash flow. Okay, the total equity is then everything here, the share capital plus the retained earnings plus the cumulative net income, and then you subtract then the dividends that you have paid, and then you add up the liabilities and the equity, and that must be exactly the same as the assets. If not, the thing is not balanced. It is an unbalanced sheet. Okay, so here I have a check to be sure that it perfectly balances, and of course at my first try it didn't balance. I have to correct a lot of mistakes until it balanced. Okay, so that's it. I have my whole financials. I have my income statement, my cash flow, and my balance sheet. Everything I left it at the bottom: the short-term debt, the accounts payable, the accounts receivable, the cost of sales, and these metrics that help me to distribute my payments and my collections. So I'm pretty happy with it. A couple more things need to be done for my next chapter. Please stay tuned, which you will have the dashboard, which is something very cool, something that it's required to modify your assumptions and see immediately the results. And last but not least, my sensibility analysis, something that you will love. I will use Excel macros for that, and it's a very nice chapter. So thank you very much for staying up to this late, and of course see you on the next chapter. And don't forget to subscribe. Thank you very much. Bye bye.